How does money flow into a private equity fund? This is a question that somebody asked me on my YouTube channel. So I'm going to address this question right away. So understand this, that a private equity fund is a fund that has been formed as a partnership comprising general partner and limited partners. As already explained in many videos before, the general partner is one who runs the fund. They are the ones who set up the fund. They collect capital from limited partners. They run the operations of the fund. They identify investments that have to be made in the private equity space. They also calculate return. They make those investments. They do the due diligence. They calculate the returns, and then they wind up the fund. So there are multiple things that the general partner does, and therefore the general partner is literally the arm and the face and the body of the fund. On the other hand, there are limited partners who contribute capital and restrict themselves to capital contribution and do not actively participate in the day-to-day operations of the fund. So private equity fund is very unique in terms of understanding the flow of the fund while making investment decisions. Okay. So the fund, while it is formed, let's say on 1st of April 2020, which is not a very great year to start the fund, but anyway, let's assume that they had a sad little April Fool's Day on 1st April 2020. Then they do not invest the entire capital that is collected on a deadline of 30th of December 2020 or something like that. Okay, the flow of capital from the fund into its investee companies is very staggered. It takes place at different points of time. Okay, and this is the most defining aspect of understanding capital inflow into the fund and capital investments made by the fund into investee companies. Okay, so you must understand that if the fund is formed on 1st of April 2020, they will take staggered decisions regarding how they can invest in investee companies. So their investments in different investee companies take place at different points of time. Okay, so if it's a 7-year fund, for example, the first 2.5 years literally goes only in identifying and investing opportunities. Does it stop after that? No, it doesn't stop after that. It continues after that. Okay, so they will invest if they find the right opportunity to invest in. Therefore, the investments made by the private equity fund are over at points of time. Okay, unlike a hedge fund which is investing on a daily basis. Okay, the hedge fund is literally buying, selling, trading in futures and options, equities, bonds, fixed income securities, etc. on a daily basis, and therefore hedge funds operate in a little different manner in terms of capital outflow. But private equity funds will make decisions at points of time. Okay, so the capital outflow from the private equity fund is not at a single point of time but at different points of time. Okay, so this timeline is very important to appreciate, because then there is no point in the fund collecting capital from the LPs and then investing in different investee companies, okay, or in different portfolio companies. So once the fund flow, the cash flow of the PE fund is understood in terms of appreciating the fact that it happens at points of time over a staggered duration, then the inflow into the fund also happens accordingly. Therefore, when the fund is formed, they do not collect capital at one time. What they do is they form the fund, and at the time of forming the fund, they already have in place what is called as capital commitments from different investors. So when they have capital commitments from different LPs or from different funds into the fund, the commitment to capital is a written commitment. Okay, it's not a fund flow. It's not a there's no movement of funds in this case. All right, when the fund identifies different opportunities, okay, then the fund makes what is called as a capital call to its investors. Once the capital call is made to the investors, then the investors contribute the capital. So the three stages of capital raising, fundraising for a private equity fund is capital commitments. This happens before signing the limited partnership agreement. The second one is capital comes into the company, but not the entire capital commitment. The capital comes into the private equity fund from the limited partners because they've already signed the limited partnership agreement. That is stage two. Stage three is when actual opportunities are identified. Then the general partner makes a call, capital call to the limited partners. And the fourth stage is the capital contribution comes in. Okay. So the flow of capital cannot be compared to, let's say, an IPO. All right. In an IPO, remember when a company does an IPO, it collects capital from everybody at the same time in a small duration of time, right? So at one point of time, it has got absolutely large amount of funds lying at its disposal. Yeah. And then it has to decide how it's going to invest that funds. But that is not the case in a private equity fund. In a private equity fund, the flow of capital from different partners into the fund is also staggered. Does that mean the private equity fund starts off with zero capital? No. It collects capital at initial stage after signing the limited partnership agreement. So, but it must also know what is the contribution of each of the partners, and hence it signs the capital commitment so that they know what are the interest levels evinced by the limited partners into the fund. Once the limited partners have signed and have agreed that this is the kind of capital that they're going to contribute into the fund, that is capital commitment, the private equity fund then has an idea about the size of the transaction, about the kind of funds it can invest in. So these are all extremely critical aspects of understanding why investing in private equity funds and the cash flows thereof for both the private equity fund and its limited partners is staggered. It doesn't happen at a point of time. It's important to appreciate the timeline between capital going into the private equity fund and second exiting the fund. Okay, exiting the fund as another concept of waterfall distribution, that is a distribution of profits between the private equity fund and the partners. So this concept of why capital has to be raised by a PE fund in 4 stages before it is very important to appreciate about the fund flow position of a private equity fund. So once we know these 4 concepts of how capital committed by the limited partners, capital is then contributed but not the entire committed capital, then we make a capital call, and then there's capital flow. Okay, these 4 stages are very important to appreciate that that even though the fund may have been formed or was formed on 1st April 2020, the entire capital consumption by a single limited partner might take at least 18 to 24 months, okay, vis-a-vis the capital contributed. And of course, if it's a top performing fund, then the limited partners can always up their stake beyond the capital commitment. But generally speaking, private equity funds like to have a closed kind of a structure, and therefore private equity funds are also close-ended funds, at least up to the point of the time that they have the requirement of additional capital to the investors. So this flow of capital from the partners into the fund stems from the fact that the capital flow from the investment flow from the fund into its various investee companies also happens at staggered points of time. For example, if the initial capital was contributed on 1st April 2020, by the time all the capital is invested by the private equity fund over the first 3-4 years is then invested in different portfolio companies. It could be at least 24 months, sometimes even 36 months. Okay, and that is a very critical aspect of understanding why timing is so important in private equity funds, why there is a concept of appreciating the fact that there is a waterfall concept at the time of profit distribution. Okay, and it's not just a mere what do we say, management fee, performance fee kind of a situation that is there in hedge funds. Okay, it's much more dramatic, it's much more continuous over here, because remember, the partners, everybody over here is waiting for that big mega exit which can take place either by way of an IPO, which is an initial public offering, or exiting from the investee company and then selling the stake to another investor. They're all waiting for that mega exit for which the fund will then make money. That's still, 4 years, 5 years hence from the initial investment, and therefore the flow of funds from the private equity fund into the investment companies literally drives the flow of capital from the limited partners into the private equity fund.